Namaskar and hearty welcome to Bhartiya Bank Coaching Centre. In this video, we begin our two-part series on KYC, AML and CFT, the core area of compliance for every banking professional. Today, in part 1, we'll cover fundamental concepts like KYC, money laundering, the stages involved, and legal and institutional framework. KYC stands for Know Your Customer. It is a mandatory process of verifying identity of customers while undertaking a transaction either by establishing an account-based relationship or otherwise, and monitor their transactions to prevent bank being misused for financial crimes like money laundering, terrorist financing, and fraud. It ensures trust and integrity in banking. Non-compliance leads to penalties, reputational damage, and legal consequences. The various sources of generating illegal money are drug trafficking, corruption, forgery, smuggling, extortion, gambling, fraud, tax evasion, kidnapping, etc. Now, what is money laundering? Money laundering is the process of converting illegal or dirty money into legitimate or clean assets or money. Financing of terrorism is done through collection of funds to support a terrorist act or organization. Money laundering typically happens in three stages: placement, layering, and integration. Let us understand these one by one. In the placement stage, illegal money is introduced in the financial system. In layering stage, it is being moved around from one account to another account, from one company to another company. Sometimes it is sent to offshore, some shell companies, and money is again brought back in the guise of some fraud invoices. Of, and then in the final stage, it is called integration. The money re-enters the economy looking clean. What are the legal backgrounds for the KYC guidelines? Money laundering and terrorism financing is a global problem. Financial Action Task Force was founded in 1989 on the initiative of the Group 7 countries to develop policies and guidelines to combat money laundering and financing terrorism, with its headquarters in Paris. At present, 38 countries and two major regional organizations like European Union and Gulf Cooperation Councils are its members, thus expanding its total network to 187 countries, having financial intelligence unit to combat money laundering and terrorism financing. FATF has issued 40 recommendations on money laundering and 9 special recommendations on terrorism financing to set the international standard for anti-money laundering measures and for combating the financing of terrorism and terrorist activities. Accordingly, in India, KYC and AML compliance is governed by the Prevention of Money Laundering Act, or in short PMLA 2002, and Prevention of Money Laundering Rules 2005, and guidelines from RBI through its master circulars, Aadhaar Act 2016, and FIU-IND, Financial Intelligence Unit IND, which was established in 2004 with its headquarters at New Delhi and is responsible for receiving reports, analyzing, and disseminating to the competent authority, and disclosure of financial information concerning suspected proceeds of crime and potential financing of terrorism. Now, two key roles are there, namely designated director and principal officer. Designated director is nominated by the board to ensure overall compliance of the PML Act. Principal officer is nominated by the bank for monitoring transaction, ensuring compliance, and reporting information as required under the law or regulation. Every bank follows a KYC policy based on four pillars: customer acceptance policy, customer identification procedures, monitoring of transaction, and risk management. A customer acceptance policy. Bank must not open anonymous or fictitious accounts. Policies should clearly define acceptable policies, application of appropriate customer due diligence measures, and rejection of customers with insufficient or suspicious KYC details. Customer due diligence procedure are to be applied at UCIC level, that is Unique Customer Identification Code level. And it should be implemented for all the joint account holders also. Identity of the customers should not match with any person or entity whose name appears in the RBI sanction list. Risk categorization of customers. Customers are classified as low, medium, or high risk based on their profile, nature of business, location, and transaction pattern. Low risk customers whose identities and sources of wealth can be easily monitored are like salaried persons, pensioners, small farmers, etc. Medium and high risk customers are those who are likely to pose a higher than average risk. They need enhanced due diligence. Examples of medium risk customers are traders, small business, new accounts during the first 180 days, inoperative accounts, etc. High risk customers examples are politically exposed persons, NRIs, trusts, NGOs, and non-face-to-face customer. Now, what is PEPs and non-face-to-face customer? That we'll understand in the subsequent slides. Periodic updation of KYC. Periodic review of risk categorization has to be done at least once in 6 months. Again, periodic updation of KYC and CDD of the customers shall be carried out at least once in every 2 years for high risk customers, once in every 8 years for medium risk customers, and once in every 10 years for low risk customers. However, low risk customers having no change in their identities and address can provide only self-certification to that effect. Normally, OBD or consent forwarded by the customers through mail or post, etc., shall be acceptable unless there are sufficient reasons for physical presence to establish their bona fides. Acknowledgement with date of having performed KYC should be provided to the customers. Let us summarize our part 1 presentation. KYC is essential to provide misuse of the financial system. Money laundering happens in 3 stages: placement, layering, and integration. The legal framework of PMLA is Financial Action Task Force, PMLA 2002, PMLA Rules 2005, FIU-IND, RBI's Master Circulars, Aadhaar, etc. So that forms the legal and compliance framework for PMLA. KYC policy has got 4 key elements: customer acceptance policy, customer identification procedures, risk categorization, and ongoing due diligence. Risk categorization and customer acceptance policy helps bank to manage compliance better. Practical tips for bank staff. As a banker, here is what you must always follow. 1. Always verify KYC documents thoroughly. Update KYC records periodically. Stay alert for suspicious transaction activities. Keep your eye, ear, etc. always alert. Report anything unusual to your branch compliance officer. Maintain confidentiality and follow documentation rules. In the next video, we'll cover customer due diligence, officially valid documents, ongoing and enhanced due diligence, non-face-to-face accounts, small accounts, and reporting of suspicious transactions. Subscribe to our YouTube channels for more practical banking lessons. Thank you.